Hello Proponomics people, and welcome to the Sunday supplement from Sunday the 5th of May 2024. And this week's was called Sideways and Slowly Upwards, which is a bit symptomatic of how I'm feeling about the housing market at the moment in general, in terms of the figures that are coming out. Obviously what we're seeing at the moment, somewhat even in Halifax and nationwide terms, is still a product of some of the things we've seen over the past few months happening in the market, because not everything they do in their house price indices is based on the mortgage offers that they're issuing in that month. Although there's a bit of obfuscation and a bit of dark art about how the house price indices are constructed. The methodology is obviously a bit different because they come up with different figures every month, but of course they're different businesses as well, and this is why we can only really rely on the ONS. But the problem with the ONS is those figures tend to come out several months after the event, so if we're trying to do things in real time and forecast forward, they're not that useful. Right, so before I get started properly, I just want to highlight our upcoming property business workshop that's going to be in London on the 4th of July. That's a Thursday, a couple of months' time. And we've already sold 16 tickets, and we'll only have a maximum of 50 at the workshop. So get in there quickly. We've got a super early bird offer on at the moment. We'll be talking about the fundamentals of property investment, risk mitigation and control, relevant investment metrics, differing secured debt arrangements and loan structures, and we'll be talking about scaling your property portfolio and business. Why, when, and how to do it, most importantly. So, as I say, some super early bird tickets left. Once those are gone, they're gone, and you'll be back to full price. So, the link for the workshop is bit.ly/PBWTHERE. That's PBW3. So, anyway, back to the supplement. We had a week where it felt the gilt yield bumped its head against the very top of my range, which is sort of 4.25 is what I've been saying. We had a bit of 4.3 and above, but then it dropped a fair amount due to a couple of different offshore events. Our onshore macro events were a little bit thinner than what happened abroad, but plenty of interesting reports to look at as we enter into a new month. So plenty in today, don't worry. So I focus on the Bank of England money and credit report release, and then also the mortgage lending, consumer credit and the money supply that all come out of that report, the nationwide house price index, and the S&P global PMIs as they were finalised for April, and then of course the gilt and swap yields as I've already touched upon. I then take a look at the Zoopla house price index in some more detail for April, and a couple of the ONS quarterly and monthly reports that attempt to give us their own slightly different take on real-time information. The ONS know that they're weak on real-time information, but they do have a go, and they have some interesting ways of looking at it. For those who haven't heard of it, the Big Mac Index is often a way that economists will look at the relative price or cost of living across countries, and you'll find that places like Switzerland, for example, normally come top or very, very high up in the Big Mac Index because it's very expensive to live in Switzerland. So it's a very simple concept of purchasing power parity, as the economists call it, and there's a little bit of that in this week's as well from the ONS. So, I like to try and focus on real-time information, as I've been saying. It's just so much more powerful than some of the long-term figures. I became embroiled in a small debate this week as a video I put up some weeks ago, which was daring to critique the current darling of the left as far as economists go. That's Gary Stevenson, an ex-trader who's just written a book called The Trading Game. I'm not denigrating Gary completely. Well worth reading the book. Really good book. Great story. Really interesting, well worth checking him out. A really, really compelling storyteller as well. Lots and lots of traction, loads of, a couple of 100,000 YouTube subscribers, really taking off at the moment. But most of the comments are along the lines of, Gary's amazing, he makes so much sense, etc., etc. All the issues that I've raised with what he's saying are all along factual lines, and all I've done is provide some actual data that challenges what he's saying and his chief cause, to which I get complete tumbleweed in response, because a worryingly large and growing segment of today's society, facts and data don't seem to matter to them or even get in the way of what feels right to them. So go and check that out if you've got time. I also wanted to articulate something about interest rates today as we get another week closer to the election, whenever it's called. It will go some way to answering that question. When will rates come down? Or at least provide some further insight into the way I'm thinking about that question at the moment. So just before I steam into the macro, I also want to sneak in the headline from Christopher Watkin, who is, in my opinion, the best provider of real-time residential property stats in the game. His strapline for this week, Best week for house sales since July 2022. Now that was the week ending the 28th of April, because the stats are a week behind, but still not bad in terms of real time. I think that speaks for itself. It's effectively repaired the Liz Truss bubble deflation, which was not necessarily a bad thing anyway for the longer term, with inflation working its magic since then. CPIH, including housing, is up 8.6% in that time period, and wages are ahead of that. So the highlights compared to the old days, well, total gross sales year to date, 7% up on 2017 to 2019, which is our best benchmark period pre-pandemic, of course. Listings are still high, 11.7% more property than the 8-year average on the market at the moment. Lots of people who'd quite like to sell. And a cumulative net sales year to date is up 5.3% on the 17 to 19 average. So it would feel like the market's functioning in an environment where the best price resi rates are around the 4.6% mark, and people will, on average, be paying low fives on newly drawn mortgage money in about 4 to 5 months' time, in my view. Resilient is the word, flying in the face of the analysts, or most of them anyway. Some of us have been pretty accurate on terms of price movements over the last 18 months, of course. Anyway, on with the macro. So, firstly, monthly money and credit report from the Bank of England. The headlines were net mortgage approvals stayed above 60,000 for the month, and moved from 60.5k in Feb to 61.3 in March, so nudging upwards. Not really expected after Halifax's March number, which was minus 1% in terms of the market, although, as I said, that's not just compiled on offers. And at the time, it did look a little anomalous, the minus one. 60k has historically been a relatively healthy market. We prefer to see the number more like 65 to 70k, which is where we were bumbling along business sort of 2014 and 2019 for a market moving forward, slowly-ish, but relatively nicely. Although, as I said, the market has been resilient. It's been from a lower and more sensible base thanks to price developments throughout 2023 and also thanks to inflation. So the newly drawn mortgage rate was down from 4.9 in Feb to 4.73 in March. 8 billion was issued net in terms of bonds, and 10.2 billion was raised by private companies that are not financial institutions. Now that's the biggest number since May 2020. Is this because projects are stacking up at the rates in the new world? Well, it really must be if it's net bond issuance, which is good news really. That money is likely to be invested over the coming months. Households' holding of money increased more than it had done for around 18 months, with 8.5 billion going on to households' net holdings. The money supply continues to expand, a little faster than expected. 0.7% more money month on month in the money supply after a 0.6% expansion in February. Still not really something that fits with a 2% inflation narrative, I'm afraid, folks. But overall, there's still less mortgage money out there than a year ago, and a year's inflation to consider on all of that as well. Net approvals for remortgaging was also down from 37.7k to 34.2k. So overall, there were fewer mortgages written for the month of March than in Feb. The very steady tick upwards on the outstanding debt moved from 3.48 to 3.5. So that's the cost of all the debt that's outstanding on mortgages. At the moment is an average of 3.5%. New debt of 4.73. That means new is still 35% more expensive than existing. If you're just talking about the interest side of it, of course, the capital repayment side is going to stay the same. If you're looking at capital repayment mortgages, which of course the vast majority of mortgages are, although not in the investment world. It gives us some idea of the individual impact of when someone drops off a fixed rate at the moment, though, doesn't it? So, the money supply is the bit that still has me looking and saying, 2% inflation? No chance, not on a sustained basis under current conditions. Nationwide's house price index then, another negative print here, not minus 0.4. From the change in mortgage pricing for April, I'm not surprised to see that, but the market data's not really playing ball with this figure though, as we see from Chris Watkins' stats. Still, they see it as 0.6% up year on year, and this was accompanied by a recent publication from Nationwide, which really tells you about what's going on the ground. So they use some of their own debit card information, and this is quite interesting. Essential cost spending down 4% in March. So that's based on debit and credit card, as I say, data that they've got. It's over $500 million worth of volume. It's not a small amount. That's offset by a 4% rise in non-essential spending. So they see this as warmer weather and stabilising costs, although they point out that rent and mortgage payments and supermarket costs are still somewhat elevated. That last sentence deserves a little bit to be dwelt on, in my opinion. Those who waste their time with ideology have missed the critical point here. The cost of shelter, whether that be rent or mortgage, has gone up considerably. Even for the 36% of households that own a property with no mortgage, council tax, bills and the likes are still up by a decent percentage. Worth repeating. Some important detail was shared in the report too, some good insight around first-time buyers. Over 50% of first-time buyers delayed a first home purchase because house prices are too high, which feels like perception and not reality, as I've been saying for some time. Once they've been adjusted for inflation, once they've been adjusted for wage increases, but 41% said higher mortgage costs were preventing them from buying. 55% said they were willing to buy in another part of the country where prices are cheaper or where they could buy a bigger property. Half said they would move more than 30 miles from their current location. The common compromise, 32%, is to buy a smaller property than wanted, and 28% would go for a property needing work doing to save money. Of those who have bought in the last 5 years, 38% said they compromised, 40% bought a property to do up, and 34% bought in a different, i.e. cheaper, area. Most interestingly of all, I thought, though, is that the fifth biggest reason was cannot borrow enough in terms of delaying first-time home purchases. Only 20% were suffering from this problem. So the main reasons were both of perception, either prices too high or mortgage costs perceived as too high, or buyer's remorse for missing the low rates. That indicates to me that when reality really kicks in for the fence sitters, that there are lots of coiled spring first-time buyers waiting in the wings. Headlines at the beginning of the year once again suggested prices will fall, about half as bearish as the headlines at the start of 2023. So perhaps when that stops, which will take a 3 to 6 month sustained period of house rises, not coming until after the election at this point, and as the election uncertainty always derails the train somewhat, in my opinion. The press will only call it when it's already been happening, and there will always be doom and gloom headlines anyway, as you know, because that's the business. 84% of respondents said that the cost of living has affected their plans to buy. With wage growth now well outpacing inflation, this is bound to be coming down at a relatively quick rate at this point. This survey was also done in March, before National Pay Rise Month, as April 2024 should have been known. Now, I went into the PMIs in some detail last week, and this week they've been confirmed for April, marginally even hotter for services than last week's flash print, as the 54.9 became 55 in the official figures. So what's the headlines from the report? Well, we were at 53.1 for March, which is a good print anyway. 50 is the benchmark, the baseline. And we became 55 for April. That's the fastest activity growth since May 2023. The input costs increased by more than any month since August 2023, although with minimum wage up so much, I was surprised it wasn't further back than that. Employment rose across the sector, but only by a very small amount. 39% said that cost burdens grew, 1% said they shrank. Charge inflation is at its lowest since April 2021, but it's still robust, although some reported that competitive pressures have led to some promotional discounting. And then 54% expect a rise in business activity over the next 12 months, and only 10% predict a decline. So really quite optimistic. That leaves us with the gilts. We went in the right direction this week and reversed last week's pain, opening at 4.225 and closing the 5-year yield on Friday at 4.107%. With Thursday's close at 4.178%, all on the 5-year. The movement downwards, and there were very small gaps down really when it did move this week, were based on a calm US Federal Reserve meeting with no changes and no surprises in the rhetoric. The Thursday night close for the 5-year swap was 4.112, so it's preserving that discount below the actual gilt, sort of 6 to 10 basis points is what we're seeing. That's where we need it to be, but that's not going to change until money gets cheaper, as I've been saying. There's no premium for that money at the moment, and while we stay above 4% for the base cost or the risk-free rate, there's unlikely to be that much movement in that premium, in my opinion. This week's cost of debt, therefore, with no fee, 6.2% is about where it is, and could be 6.1 based on Thursday's swap. Can this 2% margin be squashed is a question I've been asking myself for some time. Not down to 1.5, I don't think, but historically margins have come from savers, and a buy-to-let rate in a limited company, where the majority of investment property transactions are now taking place, really needs to get under 6% and really under 5.5% to get buyers back to the market. You can play with fees and the likes, but the only time people are going to swallow 5% fees, in my view, is when they think that 5-year growth is 15 to 25%, because 5% is an awful lot to give away, and it only saves you 1% a year, roughly, on the rate. So that's the end of the macro for one more week. On to the reports of interest. Firstly, the Zoopla house price index. With prices still down 0.2 year on year, according to Zoopla, they do recognise that market activity is improving. If you don't follow Richard Donnell, the Exec Director of Research on LinkedIn, you really should, if you like the source data. If you trust me to read it for you, that's fine too. They have April in the book as plus 0.1% month on month. Zoopla sees the Midlands and Wales as relatively flat in pricing and drops to the south of this line, including the southeast, ex-London, taking it hardest with a 1.6% drop year on year, according to Zoopla. Scotland and the northern regions do well with 1 to 2% rises, and Northern Ireland is up 4.4%. Whether this is a Brexit impact or not could be speculated on, of course. Zoopla says 64% of UK homes are in local authority areas where prices are falling on an annual basis. I think they mean have fallen rather than are falling, to be pedantic. In October 23, however, this percentage was 82%. None of these are in the northeast, but in the south of England, between 95 and 100% of homes are in markets with house prices that have fallen over the past 12 months. In the East Midlands, it's 93%, even though the East Midlands annual number is only minus 0.2%. Another way of interpreting this, the markets recovering the fastest, according to Zoopla, are Wales, the West Midlands, Yorkshire and Humberside, Scotland, the North West and the North East. A sentence that brought a smile to my face from the report: the housing market is more balanced than at any time since before the pandemic. This is likely to give more people the chance to move home in 2024. Affordability is not worsening, they say, as prices are static. Again, being pedantic, I think this should say improving, since wages are improving still at 6% a year. Zoopla expects 1.1 million transactions this year, up from 1 million or so last year. Probably a good stab given the election will get in the way. Otherwise, I'd think there might be more. Richard predicts a 4.5% mortgage rate for 2024 for Resi to be relatively consistent. I'd say that's not a bad stab at all, but he equates that to plus or minus 1 on house price growth. That's where we part company, because I don't think he's factored in wage inflation as a whole in that. I think it's more consistent with my 3 to 5% prediction this year for price rises. There are also some numbers which are not representative but still worthwhile, showing that mortgage costs are up 61% since March 2021. Now that's cherry picking the nut low, the best possible month you could have taken out a mortgage product, bear in mind. Across the south, Zoopla sees a £5,000 per year average in the cost of a mortgage, with that figure being £7,500 in London. This is a fair bit higher than the Bank of England's £200 per month figure that was published in 2023. That's at the very bottom of Zoopla's range for mortgage increases. Richard concludes by saying he sees no signs of an uptick in house price inflation. The sole subject to contract figures disagree, as I said earlier, from Christopher Watkin, and the growth will be in sales volume, not price, for the foreseeable future. We're about 4% apart on our predictions for 2024, so it's not exactly a chasm, but let's see what happens. So the ONS also on a monthly basis releases some reports of interest that are more real time than a lot of their information, and I wanted to spend a little bit of time just highlighting some stats from those, as I think they had some real time value. The one that made the most impression and generated a massive 5 likes on X, where the ONS has 355,000 followers and 0 headlines otherwise, was public service productivity in quarter 4 2023 is estimated to be 6.8% below its pre-coronavirus pandemic peak, which was quarter 4 2019. Now look, I appreciate I get more excited than the average bear about all of this stuff, but this actually potentially looks like great news. COVID cost us an awful lot, and not just in monetary terms. However, this suggests that a return to the previous levels of competency could actually see the considerable public sector cuts that are in the pipeline for 2025 and beyond not make a terrible difference to output. Overall, I think that's a massive positive. Public sector productivity is down 2.3% year on year and 1% quarter on quarter. Strikes won't have helped, but industrial action levels are actually down, certainly in the last quarter of 2023. Business demography is also of interest. Business creations were 6.1% higher than a year ago. Q1 2023 was the lowest Q1 on record so far. The largest increase came from business administration and support services that were up 28%. Business closures were also 17.2% down year on year. A parallel year would be 2018 on those figures for creations, which frankly would be just fine. Closures still look 10% or so higher than the pre-pandemic average, although they do look very similar to 2018 too. These are trading businesses. If you don't operate either VAT or PAYE, you aren't included. So that would leave out a lot of one-person bands as well as investment companies, of course, but it makes sense to make the figures more robust. On the flip side, it wouldn't capture what's going on at the very small end of SMEs. The last report I wanted to cover is the Economic Activity and Social Change Report, updated weekly. Direct debits up 4% on average year on year, which must be a pretty good inflation proxy, very close to CPIH at 3.8. Debit card transactions down overall, more for 55 plus year olds than others. 11% more direct debits are failing than 1 year ago. Aggregate spend on UK credit and debit cards is down 8% year on year. Now that's some consumption haircut, and it must be helping with inflation. That's a great real world example of an old cliche. The best cure for high prices is high prices. Still, with inflation still not down to target, the broken record is on again. Staple purchases were down 12% year on year and delayable purchases down 9%, which suggests the rest was made up by people not compromising on non-essentials. Consumption feeds inflation, or disinflation, based on these figures, which is good news overall, and is what Swati Dhingra, the one person who's going to vote downwards in the Bank of England meeting this week, has been going on about for some months now. So interesting figures there. Job adverts, as measured by Adzuna data, are down 20% year on year, with London job ads down 27% and Scotland job ads down 34%. The largest decreases are in domestic help, which would be seen as non-essential mostly, you'd think, 52% down, and also in construction and trades, which is down 47% year on year. The number of potential redundancies in the week was 14% below the level of the equivalent last year, and the quit rate, or the number of employees proposing redundancy, was down 3% year on year. Electricity prices spiked massively, 36% up week on week, but still 29% below the level seen in 2023. Bit crazy on the volatility though. Gas prices were down 4%, and they were 20% below the 2023 prices. Whether the electricity spike will affect the July price gap, we're going to see. It's going to depend on that overall volatility. Sometimes it can just be a week's different in terms of how much intermittent power is or isn't produced. There can be all sorts of reasons, so we need to be very careful with a week's worth of data, as you'll appreciate. But if I attempt to draw all of that together, then where does it leave us in a tail of the tape style situation? Consumption does seem to have abated somewhat, and people are preferring to save. This helps to cool inflation because companies then have to resort to discounting to tempt the pounds out of the pockets. This helps and will help to get inflation downwards. But money is out there, currently flowing into savings, which of course acts as a thing again. 5% accounts are out there. Okay, that's 3% after tax if you pay tax at 40%, but still 3% when it was less than 1% before. That all adds income to the pot and further tax revenue. Remember, the huge beneficiaries from the stimulus of 2020, whilst we spend all that time worrying and talking about the debt that it created, were the households, primarily due to the rise in the value of land or the properties on top of that land. Household balance sheets had grown well above the rate of inflation, although it's caught up now. Those official figures are so far behind with no real-time indicators, it's hard to say what's happened, although we know 2022 won't have been as good as the previous years. Although property prices were still up 7.6% according to the ONS, compared to minus 2.2% for 2023. Stocks did badly and inflation was also in double digits. So what we really want are real household balance sheets rather than nominal ones. But if we put the household balance sheets next to the national debt in nominal terms, the comparison works. More money is out there. The money supply is rising and has risen more than anyone would like in the past 2 months. That's not helpful for inflation and not helpful for rates. The economy is doing fine on all real-time measures. Job openings are going to start to be a worry soon, but the positivity from all the surveys suggests to me that more hiring is going to go on, not less. And we've seen a wobble rather than a continuing decline here. So unemployment to me doesn't look in much danger at all of going above 4.5% this year. A fine economy means no reason to cut rates, says The Economist. One rate cut before an election would be very, 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 very helpful to the incumbent party, says the political cynic. The Deputy Governor for Monetary Policy is about to be changed to a Hunt loyalist. 1 + 1 + 1 = 3, does it? Or does it not? The external committee members won't play ball. Bailey will listen to the incoming new deputy, Lombardelli. Dhingra wants to cut anyway, but it isn't easy. I would rather frame it as, we'd all love them to cut rates. There's no good reason to cut them in the wider macro sense at the moment. That still doesn't mean there won't be a cut, but a cut before Q3 I would now see as highly unlikely, and a cut before the end of the year probably shouldn't be justified, but could easily happen for political reasons. So if you're hanging out for lower rates, don't let that spur you into inaction. When inflation figures come out on Wednesday the 22nd of May, the figures will start with a 2 on CPI. There could be an emotional reaction to that in the markets, but the consensus will have to form, and then how far the print is from that consensus is the interesting part, either side. As for inflation, another question that crops up on occasion, why 2% as the target? Why obsess over it? Well, it is the target, but it's only the target. It can't be controlled within 0.1% or anywhere near, really, to be honest. But the job is only to have a forecast that shows we will reach 2% inflation in 3 years' time. Every meeting for the bank, that 3 years' time is another month or two away. It all comes down to the models. On that subject, I've avoided a deeper dive into the Bernanke report on the bank's forecasting efforts over the past several years that's been out in the past few weeks. There's not enough value for everyone to deep dive into it, just something for me to geek out on, which told me what I already knew and I've already been saying, to be honest. Spoiler alert, the bank's been rubbish at predictions, particularly on unemployment, but also on inflation, and not great on growth either. The hook they get let off, so have the other central banks in the world, so there you go. The bones of the report, there's too much fluff, not enough clarity in overall bank communications, and the models are rubbish, and that's why the forecasts are rubbish. They need updating. The bank also has masses of extremely experienced PhDs and the likes that they don't make enough use of. IT infrastructure is out of date, models aren't talking to each other. Bit of a joke when managing a £1 trillion balance sheet and an interest rate and bond portfolio that makes tens of billions of difference each time there's a bad decision. More if you let a lettuce anywhere near number 10, although you can't blame the bank for that. You could blame them for the way they reacted, as Peston does on the Rest Is Money pod that I highlighted a couple of weeks back. The bank is accepting all of the recommendations in the report, and it actually looks a very robust piece of work with lots of sensible suggestions. Will they therefore get better at forecasting? Not holding my breath at this end. Well done as always for getting to the end, and remember those super early bird tickets for the next property business workshop, Thursday the 4th of July, bit.ly/PBWTHREE. Now there's only one way we can deal with all this continual noise, of course. Keep calm, always listen to the supplement, and carry on.